Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as our webinars as in shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage to talk about strategy benchmarks, risk premium versus implied volatility. Welcome, D. How you doing?
Good morning, Will. How are you?
Great. I'm going to add your screen to the stage, and we'll get started.
Yeah, so let me show an example here, navigate to a page before we get started. So let's just use Google in our example because we've been using that as the default symbol. So we come to a Google, right now we're on the Google summary page, and today's discussion, I think it involves, how do we measure option premiums or options, and when we think about it, usually we reference implied volatility, which is a good benchmark or good indicator of an option contract, or maybe just the implied volatility of the at the monies. But what if we wanted to go deeper and look at strategies? So the implied volatility is not good if we wanted to get a quick assessment of the cost or premium of a strategy that involves multi-legs. So as an example here, when we look at Google, we have this 30-day implied volatility, which is a 30-day constant maturity implied volatility of at the money options. And we could do that by looking at options that straddle 30 days, the expirations that straddle 30 days, use a weighted average methodology with options around the at the money to create this benchmark. So this tracks a 30-day at the money implied volatility. But what if we wanted to track a strategy, for example, a call spread? Well, call spread involves buying one option, selling another, right? So when we do that, then the implied volatility is not meaningful when we're doing combinations, right? So in that sense, what do we do to track the cost of a strategy? So implied volatility is a measurement of a level, right, of premium. But what if we have lots of, we're doing multi-leg trades, we're buying some, selling some, how do we track that? And that's where, we have a different methodology. This one we created, but I'll show you what that looks like. So under options, let's go to strategy benchmarks and click on that. And let's do maybe a call spread. So I'm going to, over here, we have these tabs and we have this call spread. I'm going to click on that. And this gives us a strategy benchmark for a call spread. So I'm going to click on this menu to minimize it, expand our screen. And when we look at a call spread, we still have to define a couple of things of what we're benchmarking, right? So because we could look up call spreads, but the call spread could be 7 days to expiration, 10 days, 9 days. So we need a constant maturity. What are we tracking? Just like, if you're tracking a 15-year mortgage or a 30-year mortgage, you got to kind of define that term, the maturity. So in this instance, we have a 30-day constant maturity. We also have 60 days, 90 days, and we have 120-day constant maturity. So now that we have the maturity, with a call spread, we also have to kind of define which strikes are we referencing, right? Because you could do a call spread that's out of the money, you could do one in the money, you you could do it different ways. Just like think of a mortgage, you could do a fixed rate, you could do a variable rate with arms, you could do like, jumbo or balloon. So you have to kind of define, well, what are we tracking here when we say call spread? So here we're looking at in 2 strikes at the money and 5% above the at the money. And we use percentages because if we can't really use dollars to standardize it, because if we say $5 spread, well, in Google, $5 spread is different than maybe in another stock that is $10, right? So Google's $200, but so $5 spread in Google is different because a $5 move in a $200 stock is a much smaller percentage than if you have a $10 stock. Right? If you have a $10 stock, a $5 moves 50%. So instead of saying the referencing stock, the price, we do by percentage away. So and at the money would start out at wherever the stock price is, and then the next leg would be 5% away. So this way we kind of normalize it across different stock prices. So this way we could compare, the cost of Google 30-day at the money, call spread that's 30 days to maturity at the money and 5% away to a different stock. So now that we defined it up here, then, well, how do we measure it? So this is what we're trying to track: 30-day constant maturity, call spread at the money, 5% out of the money. But how do we measure it? How do we track that? Because if we used implied volatilities, it would be confusing because the implied volatilities of these could be, different, moving around. So another way to do it, the way we're looking at it, is taking the implied volatilities, converting it to option premium. And that premium would be based on the percentage of the spot price. Okay, so here we could see, well, if we're looking at buying in at the money, 30-day constant maturity, and selling a 5% out of the money call, what would the cost be? Right, so what would the cost of that be? And how do we make it in relative terms? So we take that premium by looking at the option, observing the options, doing that same weighted average formula. We'll calculate the premium, compare that to the stock price, and say, well, that's the cost of it is 1.9% of the stock price. So now, by using percentages, we could compare that over time and compare that to other products, right? We could say, well, what it would be the cost of SPY call spread or some other. And because now that we have it in percentage terms, we know that that would be the percentage cost of spot price, right? So now that we have that, we could see, well, currently a 5%, right? This is a 5% call spread from at the money, going up 5%, is 1.9%, right? So it's not the full 5% right now, it's 1.9%, right? The 5% would be that would be the cost of the full, if it was totally in the money. So it's 1.9%. And then we could now use that benchmark to compare to historical. So here it says the average of all the historicals, these are the historical values, was 1.9%. So we're right at the average. We could also track the change. Well, it's 1.9% today, or currently. Well, right now we're closed, so this is as of the close. If we compare it to the previous day, we could see it's unchanged. So even though that the stock moved around, because we're using percentages, the cost of another 5% call spread is still 1.9%. And we could also compare it based on a ranking. We talked about this actually yesterday, where we have this average. What if we took all the observations and wanted to see how many fell below this cost, how many above? So this is what the ranking is. So 62% of the observations were below 1.9%, which leaves us with 38% above. So this dotted orange line is the average of all of them. These are the observations. We could see now a quick way to benchmark a strategy, right? We know implied volatilities. We could benchmark the relative values of options by referencing their implied volatility. But if we wanted to go and create strategies, like ratio call spreads, or here's like a four-leg strategy where you're buying and selling different. Well, now we have a way to quickly reference the cost of that strategy relative to its stock price and track it over time and compare it to other assets, other securities, that have different prices. So that's why in this situation, looking at the premiums, converting it to premium or cost can be beneficial to track a multi-leg strategy. So, Will, I'm going to throw that now back to you.
Great job, D. That was exceptional as always. Let me remove your screen. It's Friday, everyone, and we had another strong week of webinars. Great job, D, and thanks for everything. We'll see you Monday, buddy.
Thanks, everyone, for joining. Have a great weekend. Have a great trading day. We hope to see you next week.
See you next week, D. Bye. All right, everyone. Thanks for joining the Market Chameleon webinar series. Another week behind us, except we have a day of trading. So be safe out there. Remember, like us, follow us on all the social platforms. Sorry, Rob, I missed your arrival. I see you're in there. Everyone who's new and hasn't tried our premium service, please go to Market Chameleon, and we have a free 7-day trial. Make sure you check us out there. If you're following us on YouTube right now, remember, thumbs up, always appreciated. Everyone have a safe trading day and a great weekend. We will see you on Monday.